Welcome everyone to another Employee Superannuation Webcast. My name is Michael Furey and I'm here today on behalf of Standard Pacific, one of Suncorp's many brands. Standard Pacific is a corporate super specialist who currently provides general advice and superannuation education to its many clients. Before we get started, it's important to be aware that the information in this video is of a general nature only. So before acting on any of the material presented, you should firstly seek advice from a qualified advisor who is familiar with your personal circumstances. Today we'll be talking about how the global and Australian share markets have performed over the past 12 months. We'll also look at bond yields, the performance of the Australian dollar, and finally performance of the various asset classes. Markets began the year strongly amid further moves by US and European policymakers to boost growth, which included additional quantitative easing or QE. In layman's terms, this means printing more money. Political activity dominated financial markets into the end of 2012. This included the US presidential election, uncertainty around the so-called fiscal cliff, continued attempts to resolve the Eurozone's debt crisis, and the Japanese election, which saw a pro-stimulus party elected. Share markets made gains in the first quarter of 2013, though performance was mixed across regions. In Japan, stocks rose on the back of optimism for its economic outlook. The US market gained due to a series of better than expected economic data. However, European stocks eased amid renewed political uncertainty with an inconclusive election result in Italy and news that Cyprus would require a bailout due to its collapsing banking system. April and May were positive. However, markets pulled back in June after the US Federal Reserve announced it might taper its QE program sooner than expected. Some disappointing Chinese economic data also weighed heavily. As the table shows, all major share markets posted strong gains with the notable exception of China. The market there was hampered by a series of softer economic data and general growth concerns. The Australian share market made strong gains over the past 12 months, benefiting from the easing of monetary policy around the world and a series of Reserve Bank interest rate cuts which resulted in Australia's official cash rate dropping to a record low of 2.5%. However, similar to overseas markets, local market gains were limited late in the period. This was due to a series of softer domestic economic data and subsequent growth concerns, the US Federal Reserve taper talk, and further declines in local mining investment and Chinese growth concerns. Let's now look at the US and Australian bond yields over the past 12 months. As you can see from the graph, bond yields spiked sharply higher late in the financial year after US Federal Reserve Chairman Ben Bernanke said the central bank may taper its QE program sooner than expected. This unwinding was expected to start in September 2013. However, any move by the Fed to taper its program is dependent on economic data meeting the bank's forecasts. So what is the importance of this? Higher bond yields means the cost of money is more expensive, which can reduce investment in property and businesses, which may impact negatively on the economy. For your superannuation, higher bond yields means lower bond returns and lower returns for the more conservative investor. Another topical subject is the recent drop of the Australian dollar. Over the 2013 financial year, it traded at elevated levels but fell sharply in the last quarter. This was due to a strengthening US dollar which was strong against all currencies, commodity price weakness and expected Reserve Bank interest rate cuts. Looking ahead, the Australian dollar is likely to fall against the US dollar if the Australian economy slows and the Reserve Bank cuts interest rates even further. And finally today, let's look at the performance of asset classes. The 2013 financial year was one of those rare periods where every asset class produced positive returns. As the chart shows, the riskier asset classes of shares and property produced the strongest returns, whilst cash and bonds produced returns in the low single digits. Interestingly, this is a reversal on the previous 12-month period. For those of you invested in portfolios that were weighted towards growth assets, you should see strong performance for the financial year. Those of you in more conservative investment options should still see positive performance, although it's likely to be in single digits. Well, that brings us to the end of the presentation. Thank you for taking the time to watch this webcast and I hope you have found it informative. Please remember, if you need any assistance with your super, please call Standard Pacific or the customer service centre that is appropriate to you. Have a great day and we'll see you next time.